Today on Real Estate Backstage, the big news is that Rocket plans to acquire Redfin. Also, Compass may potentially be in talks to acquire HomeServices of America. Inflation cooled in February, but there are signs of economic weakness beginning to crop up, which is making investors nervous. A proposed bill seeks to severely disincentivize hedge funds from buying and holding single-family homes. And finally, AREA proposes an alternative to NAR's clear cooperation policy. Now, before we jump into today's conversation, if you're watching on YouTube or if you're listening on Apple Podcasts or Spotify, go ahead and subscribe to the show. That way you don't miss any future episodes. And if you're looking for the show notes where we reference all the articles from today's episode, you can find that at realestatebackstage.com/episode 22. Now, if this is your first time watching or listening, I'm your host. I'm Michael Smith, the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. All right, so today we're going to start off with this news about Rocket acquiring Redfin for $1.75 billion. Now, this is according to RIS Media. Quote, in an announcement Monday morning, Rocket, the parent company of Rocket Mortgage, Rocket Homes, and a handful of other mostly housing-focused entities, announced it is purchasing legacy portal and brokerage Redfin, marking a potentially significant power shift in the ongoing portal wars. In a statement, Rocket CEO Varun Krishna described the $1.75 billion all-stock deal as the marriage of a unified vision, adding later on a conference call that the companies have long had a close relationship. Together, we will improve the experience by connecting traditionally disparate steps of the search and financing process with leading technology that removes friction, reduces costs, and increases value to American homebuyers, Krishna said. The news comes as real estate mega companies have sought to diversify and expand their reach into other elements of the home transaction process, with the so-called portal wars putting Redfin, Zillow, Homes.com, and Realtor.com in direct competition for the first look from prospective buyers and sellers. How the deal will affect the balance of power remains to be seen. Redfin gives Rocket access to 50 million monthly visitors and a brokerage boasting 2,200 agents, among other assets. Redfin recently laid off around 400 employees after striking a deal with rival Zillow to offload its rental business, an area where Zillow has seen significant growth. According to Rocket's announcement, Mercurial Redfin CEO Glenn Kelman will remain in his role, though no other specific details were announced as far as potential employee transfers or turnover, unquote. And now this is according to Real Estate News. Quote, it appears Redfin president and CEO Glenn Kelman wasn't excited about the alternatives his company faced before agreeing to be acquired by Rocket. In an interview with the Seattle-based Puget Sound Business Journal, Kelman said that if Redfin had been sold to any other company, it would have been stripped for its parts. The company would have wanted the website, but nothing else, Kelman told the Business Journal on Wednesday, March 12th. Kelman also said in the interview that negotiations with Rocket first started in November, unquote. So my assumption is that Zillow would have loved to acquire Redfin, and if I had to guess, they've probably made several offers to do so over the years, but the leadership at Redfin didn't want to see their company assimilated into the larger Zillow group the same way that Trulia was back in 2015 after it was acquired by Zillow. All right, next up, we've got some rumors that Compass is potentially in talks to acquire HomeServices of America. Now, this is according to the Wall Street Journal. Quote, Compass is in advanced talks to acquire Warren Buffett's real estate brokerage business, according to people familiar with the matter, the latest sign of consolidation among real estate brokerages during a prolonged period of lackluster home sales. A deal could come together soon if talks don't hit any last-minute snags, the people said. The acquisition price couldn't be determined. Compass was the biggest U.S. brokerage by volume in 2023, while HomeServices was the fourth biggest, according to Real Trends. Berkshire Hathaway's HomeServices of America had about 820 brokerage offices and 270 franchisees in 2024, and its brand names include Berkshire Hathaway Home Services and Real Living. It had about 5,400 employees last year, according to Berkshire's annual report. After the Wall Street Journal story published on Thursday, HomeServices of America sent out a note saying no final deal has been reached to sell the firm to Compass. Berkshire, the conglomerate run by Buffett, rarely sells its operating companies, but real estate brokerages have struggled in recent years as high home prices and elevated mortgage rates have slowed the market. Home sales in 2024 fell to the lowest level since 1995 for the second straight year. Large brokerages have also agreed to pay hundreds of millions to settle legal claims that the industry conspired to keep agent commissions high. HomeServices was one of 4 major brokerage firms found liable in an industry antitrust case in 2023. The company reached a settlement last year for $250 million, unquote. So after the Wall Street Journal broke the story based on unnamed sources within the companies that Compass was in talks to purchase HomeServices of America, the CEO of HomeServices came out vehemently denying these allegations. So this is according to Real Estate News. Quote, HomeServices of America President and CEO Gino Blefari is strongly denying a report that Compass is in talks to purchase HomeServices of America. I want to confirm to you that there are no discussions, negotiations, or agreements to sell HomeServices or any of its affiliated companies, and that includes the Berkshire Hathaway HomeServices franchise business, Blefari said in a statement shared with franchisees. Moreover, he added, no such sale is being contemplated. It's not yet known where the story came from, Blefari said, but it's important to note that it was based on rumors from unnamed sources. He also said that HomeServices was not given notice of the article nor the opportunity to respond, unquote. So last week we discussed Keller Williams selling a major stake to the private equity firm Stone Point Capital, marking the first time that KW had taken on outside investment capital in its 42 years as a company. At the same time, they brought on a new CEO that had experience with IPOs, so there are rumors that Keller Williams is planning to go public. And of course, this week we have the news that Rocket is acquiring Redfin, and now the rumors of Compass potentially being in talks to acquire HomeServices of America. With many bigger companies struggling to grow organically in this market based on these slower market conditions, it's not surprising that we're seeing mergers and acquisitions take the center stage, and it's likely that we're going to continue to see M&A activity in the headlines throughout the rest of the year. All right, so shifting gears, let's talk about inflation. So this is according to the Wall Street Journal. Quote, inflation cooled last month, but the latest data may offer less comfort to U.S. businesses, consumers, and Federal Reserve policymakers than it otherwise would because tariffs are threatening to raise some prices in the months ahead. Consumer prices were up 2.8% in February from a year earlier, the Labor Department reported on Wednesday, versus a January gain of 3%. Economists polled by the Wall Street Journal had expected a 2.9% gain. Prices excluding food and energy categories, the so-called core measure that economists watch in an effort to better capture inflation's underlying trend, rose 3.1%. That was the lowest year-over-year reading since 2021 and was also lower than the 3.2% expected by economists, unquote. So while we are seeing some positive signs of inflation beginning to cool again after several months of us being worried about inflation heading back up in the wrong direction, that is positive news, very welcome news. However, we're also starting to see some signs that there may be some weakness in the economy. This is also according to the Wall Street Journal. Quote, American consumers have had a lot to fret about so far this year, between never-ending tariff headlines, stubborn inflation, and most recently, fresh fears about a recession. These concerns seem to be hitting spending by both rich and poor across necessities and luxuries all at once. Take low-income consumers. At an interview at the Economic Club of Chicago in late February, Walmart chief executive Doug McMillon said budget-pressured customers are showing stressed behaviors. They are buying smaller pack sizes at the end of the month because their money runs out before the month is gone. McDonald's said in its recent earnings call that the fast food industry has had a sluggish start to the year, in part because of weak demand from low-income consumers. Across the U.S. fast food industry, sales to low-income guests were down by a double-digit percentage in the fourth quarter compared to a year earlier, according to McDonald's. Dollar General, on its earnings call on Thursday, said its customers report only having enough money for basic essentials. Some are having to sacrifice even on necessities. The company doesn't expect any improvement in the economic environment this year and is watching potential changes to government entitlement programs. Dollar stores rely more heavily on food stamp benefits, which could be on the table for budget cuts. Things don't look much better on the higher end either. American consumer spending on the luxury market, which includes high-end department stores and online platforms, fell 9.3% in February from a year earlier, worse than the 5.9% decline in January, according to Citi's analysis of its credit card transactions data. Costco, whose membership fee-paying customer base skews slightly higher income, said last week that demand has shifted toward lower-cost proteins such as ground beef and poultry. Its members are still spending, but they are very choiceful about where they spend, Chief Financial Officer Gary Millerchip said. He said consumers could become even pickier if they see more inflation from tariffs. Dollar General said Thursday that sales to higher-earning households who are seeking cheaper options accelerated in the past few weeks, unquote. So historically, Donald Trump has been very successful in using tariffs as leverage in negotiations to extract specific concessions from other countries. For example, famously, he used the threat of tariffs against Mexico during his first term when he was really concerned about illegal immigration and fentanyl coming across the southern border. So the threat of a tariff, which was never actually implemented against Mexico, was enough to get them to come to the table and agree to deploy thousands of their National Guard troops across their country to help stem the flow of illegal immigration up through Mexico and across our southern border. And they also agreed to house migrants who are seeking asylum in the United States until their cases could be adjudicated. This became known as the Remain in Mexico policy. So if someone came across the U.S. southern border from Mexico seeking asylum in the United States, rather than being released into the interior and assigned a court date and asked to show back up, they were sent back down to Mexico, and Mexico would house them until their court date, until we could decide whether or not to grant them asylum. That was the Remain in Mexico policy. A lot of people consider that a big win of Donald Trump's first administration, and that came about based on the threat of tariffs against Mexico. However, I really don't understand why he's picking this fight with Canada. Donald Trump likes to talk a lot about trade deficits as if they are in and of themselves bad for America. I disagree with that. Most economists would disagree with that. Just because you have a trade deficit with someone doesn't mean that they're taking advantage of you, like Donald Trump likes to say. For example, you have a trade deficit with the grocery store that you shop at, okay? When you have a trade deficit, it just means you buy more from that country than that country buys from you. We actually have a trade surplus with Canada. Canada is one of our biggest trading partners. We actually export more to them than we import from Canada. When you look at the trade-weighted tariff rates that Canada charges on goods coming from the United States into Canada, they actually have one of the lowest tariff rates on us compared to all of the other countries around the world. Yes, they have high tariff rates on very specific products like dairy, but across the board, on average, their tariffs on U.S. goods are very, very low. If we're talking about border security, less than 1% of the fentanyl seized is coming from the northern border as opposed to the southern border. I think last year only 43 pounds of fentanyl was seized coming from Canada as opposed to like 24,000, don't quote me on that, pounds coming across the Mexican border. So I'm not really sure what the goal is here. And I don't think Donald Trump has really articulated what the end game here is with Canada. And it's the off again, on again, not sure whether or not tariffs are going to be in place or not. That type of uncertainty is creating a lot of angst and hesitation in the business community. People don't know whether to sign deals. If you're a manufacturer, if your company imports from Canada, you don't know what type of contracts to enter into right now because you don't know whether or not tariffs are going to be in place, what the tariff rates are going to be, how long they're going to be there. Really just this lack of a clearly articulated end goal when it comes to Canada specifically, I'm pretty confused about. And the markets seem pretty confused about that as well, which is why we've seen a lot of downward correction in the stock market over the last week or so. All right, I'll get off my soapbox. Let's shift gears over to new construction. Now, this is according to Inman. Quote, a decade of underbuilding has left America short 3.8 million homes, according to Realtor.com's latest market report. At the current building pace, it would take 7.5 years to close the nationwide gap. However, regional inventory trends show the distance to fulfill housing demand is longest in the Northeast and Midwest and shortest in the West and South. While builders made strides last year, the scale of the historic housing shortage paired with strong pent-up demand meant that new supply couldn't fully close the nearly 4 million home gap. Realtor.com chief economist Danielle Hale said in a statement. Young households are feeling particularly strained as buying a home on an early to mid-career salary is increasingly out of reach for many. In 2024, single-family home completions reached a two-decade high of 1.36 million. That number outpaced household formation trends for the year, which barely topped 900,000. On the multifamily side, builders have pulled the reins on developing high-density projects as vacancy rates finally show signs of improvement after 2 years of increases. Despite improving trends, it's still not enough to meaningfully improve affordability trends for homebuyers who are paying a median price of $446,300 for new builds and a median price of $396,900 for existing homes. Millennials and Gen Zers are particularly struggling to keep up, the report said, with those generations of potential homebuyers unable to form their own households. The housing gap is on track to be closed within the decade in the South, 3 years, and the West, 6.5 years. However, it will take a whopping 41 years for builders in the Midwest to fully meet demand. The Northeast has the dimmest outlook, with the gap continuing to grow by 1.2% larger annually. The rise in both multi- and single-family construction offered some relief amid low existing inventory. Addressing the gap will take sustained effort and smart policy, Hale said. So this just really shows that the whole problem we're experiencing with the housing shortage in this country is primarily on the supply side of the equation. Now, we're going to circle back around to that thought in just a moment. I want to talk about this proposed bill which seeks to limit hedge fund ownership of single-family homes in the country. Now, this is according to RIS Media. Quote, one of the bills under consideration in Congress to address the affordability crisis is the Humans Over Private Equity HOPE for Homeownership Act. Introduced in February 2025, the bill points to large financial entities purchasing single-family homes in bulk as a reason for high prices and looks to remedy it with new tax statutes. The bill's sponsors are all Democrats and Democratic-aligned independents. Thus, the bill likely has an uphill battle due to the current Republican trifecta in the House, Senate, and White House. Nonetheless, Senator Jeff Merkley, a Democrat from Oregon, the bill's original sponsor in the Senate, is continuing to advocate for its importance in addressing ongoing housing problems. Hedge funds are killing the dream of homeownership, which has been by far the biggest wealth builder for middle-class America. The HOPE for Homeownership Act is part of our strategy to tackle the housing affordability crisis by going after hedge funds that own and control large parts of the housing market, Merkley tells RIS Media via email. The bill summary cites projections that institutional investors owned about 700,000 single-family homes in 2022 and could own 40% of single-family home rentals by 2030 as a cause for concern and action. There are three planks of the legislation, which does not outright bar hedge funds from purchasing single-family homes, but rather disincentivizes them from doing so. The bill would introduce a new tax of 15% of the sales price, up to $10,000, if a hedge fund seeks to buy a single-family home. The bill would also remove tax breaks for depreciation and mortgage interest. Finally, there would also be a new $5,000 per home annual tax if a hedge fund fails to sell 10% of their single-family homes to non-homeowning families rather than another financial institution over a 10-year period. This tax would likely disincentivize financial entities from holding housing stock as a long-term rental property investment, unquote. Okay, so here's why I think this is misguided. Currently, about 17% of the single-family homes in the United States are tenant-occupied as opposed to owner-occupied, 17%. Now, of those rentals, about 3% of those are owned by what we call institutional investors. The other 97% of those rental properties are owned by mom-and-pop investors who own maybe 1, 2, or 3 rental properties. So 3% of the 17%, which means in this country, less than half of 1% of the single-family homes are owned by institutional investors. Over 99.5% of single-family homes are owned by either owner-occupants or small mom-and-pop landlords that own maybe 1, 2, or 3 rental properties. In general, I just don't see why this type of policy would make sense at the federal level. Now, you could theoretically convince me that maybe at the city, county, or state level, if there were certain markets that were seeing just immense amounts of hedge fund activity that was really negatively impacting the demand side of the equation, making it difficult for people to compete and purchase a home, we could have that conversation. You take, for example, the Austin, Texas market. This is one of those metros that saw a large amount of hedge fund purchasing activity for a couple years in the immediate aftermath after the COVID pandemic. That's why Austin had one of the highest appreciation rates in 2021, 2022. However, that has since reversed course, and we've seen a correction in prices in the Austin metro. Now, I'm sure there are certain parts of the country where the opposite is true, where regular home buyer demand is so weak that home prices are going down. And, in those particular circumstances, I think the hedge funds, the institutional investors, they could serve a valuable function by supporting home values and really providing renters with choices. Because, I think if you're going to rent a place to live, if you're not in a position to buy or if you don't want to buy, I think you should have the option of choosing to rent a single family home as opposed to having to live in an apartment. So I think we can all agree on the problem, which is the unaffordability of homeownership, but we don't all agree on the solution. Now, the problem, the unaffordability of housing, is really driven by the imbalance of supply and demand for housing in the United States. And from my perspective, the biggest issues that need solving are on the supply side of that equation. We just have not been building enough new homes in this country over the last 10 to 15 years. That's because of what happened with the 2008 financial crisis. A lot of builders went out of business. We just stopped building homes for a long period of time. So we have not been able to keep up with household formation, with population growth. And like we talked about in the article from earlier, in some markets, it's going to take decades to bridge that gap and build enough new houses to keep up with the demand. So the supply side of the equation is really what's creating the unaffordability issue. Now, on the demand side of the equation, this senator here is trying to make the case that hedge funds are accounting for most of the demand, which is making it impossible for people to buy a home, which is driving up prices. And that's just simply not true. Hedge funds, like I said, they own less than half of 1% of the single-family homes in this country. All right, so we've got an update on Donald Trump's efforts to gut the CFPB. This is according to Housing Wire. Quote, in a closely watched case that could determine the posture of the Consumer Financial Protection Bureau during the second Trump administration, a judge overseeing the case brought by the National Treasury Employees Union against CFPB Acting Director Russell Vought could rein in actions to wind down the agency. In the U.S. District Court for the District of Columbia, Judge Amy Berman Jackson heard testimony earlier this week from the Bureau's chief operating officer about the actions taken thus far by the U.S. DOJ service to scale back the CFPB's operations. Jackson is reportedly leaning toward issuing a preliminary injunction that would effectively pause a plan to wind down the agency's operations. I want to preserve an agency that could be revived if necessary, Jackson said on Tuesday, based on a report published by American Banker. I don't think that we could have nothing, unquote. So I wouldn't be surprised at all to see an injunction here. My perspective is that if Republicans want to make such dramatic changes to the CFPB or even get rid of it altogether, they're going to have to attempt to do that through Congress, and that is not going to be an easy task. Even though the Republicans have a majority in the House, a slight majority, and they have a majority in the Senate, this is going to be an uphill battle, and that's because any major legislative changes really are going to require 60 votes in the Senate rather than just a bare majority of 51. That's because of the current rules with the filibuster. So in order to overcome a filibuster, you need 60 votes, and surely the Democrats would filibuster any effort by Republicans to make such dramatic changes or to dismantle entirely the CFPB. Now, the only way to get around that filibuster is doing something called reconciliation, which is a budget allocation process. But like we've talked about previously, the CFPB is not funded through appropriations from Congress. They are funded from distributions directly from the Federal Reserve, which could make it very, very difficult for the Republicans to really do anything here without hitting that 60-vote threshold, which they are not going to hit. Now, one of the reasons the Republicans tend not to like the CFPB is because it's funded in this way, and because the Congress, which historically and famously has the power of the purse, doesn't really have the ability to allocate funds and control the funds within the CFPB, because, again, they're not funded by congressional appropriations. They receive their money directly from the Federal Reserve. All right, last but not least, we're going to wrap up with this. Area has proposed an alternative to NAR's clear cooperation policy. This is according to Inman. Quote, amid ongoing strife over the National Association of Realtors' divisive clear cooperation policy, rival trade group, the American Real Estate Association, is pitching a compromise it believes will satisfy consumers and brokers alike. The American Real Estate Association on Friday released what it describes as a clear collaboration policy, which officials called a balanced, fair policy that respects seller choice, ensures professional access to listings, and fosters a competitive real estate environment. The policy would end a one-size-fits-all approach while addressing concerns that the U.S. Department of Justice has expressed about the current status quo, its authors told Inman exclusively. The American Real Estate Association shared its proposal with members on Friday. The most significant aspect of the proposal involves how listings reach the public. Currently, clear cooperation requires realtors to feed listings into a NAR-affiliated MLS within a day of marketing the property publicly, a process that automatically sends listings to public portals like Zillow, which syndicate content from the MLSs. Critics have balked at the requirement, arguing that it bars homeowners from marketing the property how they see fit while violating consumer privacy. The proposed clear collaboration policy, however, would change that. Agents would still need to input listings into an MLS under the proposal, but those listings would not automatically or necessarily get syndicated to consumer-facing portals. Documents provided to Inman describe this approach as public portal opt-in, not forced opt-out. Agents have the ability, but not the requirement, to syndicate listing data to public platforms, the documents add. According to the American Real Estate Association, this approach would open the door for consumers to maintain their privacy. Meanwhile, licensed agents could still find even non-public listings by searching the MLS. The organization is also pitching the proposal as a boon to smaller and independent brokerages. Clear collaboration levels the playing field while maintaining a fair, transparent marketplace, documents state. That point is an apparent nod to concerns that in the absence of clear cooperation, large companies would build their own private listing networks and cut smaller players off from large swaths of the market. Other benefits of clear collaboration, according to the documents, include fostering true transparency without unnecessary restrictions, and that it eliminates outdated, punitive policies that do not serve agents or consumers. The proposal also suggests a fair listing window between the time agents share listings internally and when they have to submit them to their MLS. Jason Haber, who co-founded the American Real Estate Association, with the agency's Mauricio Umansky, told Inman, certainly one day is too rigid. For such a window, and that one interesting idea we've discussed is not having a blanket national policy on that and allowing the local MLSs to establish that timetable so it's tailored to that region, unquote. So I think Area is onto something here. I think the clear cooperation policy sounds really good on paper, and there are certainly some benefits to it. But in my opinion, there needs to be a little bit more flexibility. All right, y'all, that is a wrap for the show today. Just a reminder, you can find the show notes with links to all of the articles that we referenced at realestatebackstage.com/episode 22. Now, I'm going to be out next week because my kids are out of school for spring break, so I'm going to be at home with them. So I will see you back here in 2 weeks for another behind-the-scenes look at the real estate industry here on Real Estate Backstage.